All right, let's dive right in. Today, we're talking about a warning sign that's flashing, deep inside the global financial system. It's the kind of subtle signal that's super easy to miss, but it could have some pretty huge implications for the entire economy. So let's break down what's really going on.
So you might be thinking, a government bond auction? Why on earth should I care about something that sounds so boring? Well, it's because this is often where the first cracks of financial stress start to show. You can think of it as the canary in the coal mine for the global economy. And right now, that canary is looking a little shaky.
So what exactly set off the alarm bells? Well, the United States just had its weakest Treasury auction in more than 3 years. And look, when demand for what's supposed to be the safest investment on the planet starts to dry up, that's a huge sign that the smart money is getting really nervous about what's coming down the pike.
Okay, so a quick refresher. U.S. Treasuries are basically just loans that people and institutions make to the U.S. government so it can, pay its bills. For decades, they've been the absolute gold standard, the ultimate safe haven investment. But right now, that trust is being put to the test, and you're seeing global investors start to pump the brakes.
And this really gets us to our first major point. This is not just some technical detail buried in the financial news. It's a genuine warning sign. When you see demand for U.S. debt get weaker, it signals this growing anxiety among investors all over the world about the entire economic picture.
All right, so let's get into the specifics. The real warning shot was fired during an auction for $69 billion in 2-year notes. Demand was just way weaker than anyone expected. To get enough people to buy, the government had to offer a much better return, a higher yield, pushing it up to around 3.9%. And it wasn't just short-term debt. Yields on the longer 10 and 30-year Treasuries also shot up.
So what's causing this sudden cold feet from investors? Well, the analysis we're looking at points to two really powerful forces smashing into each other: simmering geopolitical tensions and this nagging, persistent fear of inflation. Let's dig into how those two are connected.
Okay, so picture this domino effect. The analysis highlights the escalating conflict in the Middle East, which is threatening these absolutely critical shipping lanes for energy. That threat alone has caused oil prices to surge, and that spike, it feeds directly into fears about inflation. And when investors get worried that their money is going to be worth less tomorrow, what do? They demand a higher return on their investments today. It's that simple.
Now, this whole situation creates what the analysis is calling a vicious cycle in the bond market, and it's a self-feeding loop that can be incredibly hard to escape. Let me show you how it works.
This quote right here really nails a crucial point. The U.S. government doesn't just get to decide the interest rate it pays on its debt. Nope, the market does. And who is the market? It's thousands of investors all around the globe, each one looking at the risks and deciding, okay, for this level of risk, here's the return I need to get paid.
And here's that cycle in action. It starts with weak demand, right? That forces the government to offer higher yields to sweeten the deal. But those higher yields mean the government has to spend more and more money just on interest payments. That, in turn, adds to the national debt, which, you guessed it, makes investors even more nervous, leading to even weaker demand at the next auction. You can see how this thing can just feed on itself.
To really boil it down, you can check the market's health with a really simple comparison. In a healthy market, you've got strong demand from investors, which keeps yields low. That means borrowing is cheap. But in a stressed market, the kind we're starting to see signs of now, weak demand pushes those yields way up, making borrowing more expensive for absolutely everyone.
Okay, so now let's talk about the scale of this problem. Because to really understand the kind of pressure the U.S. government is facing, you have to look at the numbers. And honestly, they're kind of mind-boggling.
First, get this. Over the next year, just the next 12 months, the U.S. has to refinance about $10 trillion of its existing debt. That means it has to go out and find new buyers for all of that, and it'll probably have to do it at these new, higher interest rates.
And if that wasn't enough, here's the second key number. Right now, about 20%, that's 1/5 of every single dollar the government brings in from taxes, is spent just making the interest payments on the debt we already have. That's before funding a single thing, not defense, not Social Security, nothing.
And just to make things even more interesting, the government isn't the only one looking for cash. You've also got corporations issuing a tidal wave of their own debt, potentially $1.4 trillion this year alone. They're all competing for the same limited pool of investor money. So you've got this massive surge in the supply of debt right as demand is getting weaker. Basic economics tells you that means prices are going to fall and yields have to go up.
So, with all this pressure building up in the system, what happens next? Where do we go from here? In our final section, let's take a look at how investors are actually reacting and what the potential paths forward look like.
So what are investors actually doing about all this? Well, they're not hitting the panic button just yet, but they are definitely making moves. They're getting more defensive, they're shortening their investment timelines, and they're basically just waiting for things to become clear. They're demanding that higher risk premium, in other words, better yields, to make up for all this uncertainty. And man, are they reacting fast to any new bit of information.
At the end of the day, the analysis really boils everything down to two possible paths forward, and it all hinges on geopolitics. If global tensions cool off and we see some de-escalation, that could stabilize bond yields and bring back some much-needed confidence. But if conflicts intensify, it's just going to pour fuel on the fire and reinforce all the trends we've been talking about: high inflation, weak demand, and a whole lot of financial stress.
So, what's the big takeaway here? It's that the bond market, this thing that usually operates quietly in the background, is a huge deal. It ultimately sets the cost of borrowing for governments, for companies, and for you and me. And when it starts sending signals like this, it's a major heads-up that bigger changes could be on the way. And that really leaves us with the final trillion-dollar question: which path are we headed down? De-escalation or intensification? Something to think about. Thanks for tuning in.